This webinar will explore the design of comprehensive assessment conducted by the ECB. Our aim is to describe its main building blocks, which should hopefully allow for better understanding of the procedures and the outcomes. We will start with a short overview of Banking Union, and I know there are a lot of participants who know everything about Banking Union, but no worries, one slide only. And at the end of part 1, I will also explain what precautionary capitalization means in respect of the comprehensive assessment. And then I will be happy to answer your questions during part 2, which is a Q&A session. Let's start with a brief recap on Banking Union. Banking Union is based on two main pillars. You will see them on our infographics. Supervision on the left and resolution on the right. Two main pillars and therefore two single mechanisms. Single supervisory mechanism for ongoing supervision of banks and single resolution mechanism for crisis management. Single supervisory mechanism will be executed by the ECB and it is ongoing day-to-day prudential supervision of most significant EU zone banks. Single resolution mechanism is a crisis management framework. It sets up single resolution board and provides tools both for early intervention and then for resolution. I think that the main achievements of single resolution mechanism, which are relevant to our topic today, are Single Resolution Fund, SRF, and the bail-in tool. Just to remind you, bail-in tool generally makes unsecured creditors participate in failing banks' losses, and SRF is a backstop pre-funded by banks and dedicated to contribute to restoring failing banks' position. Of course, it should be used only if bail-in does not do the trick. So, we have to remember, however, that bail-in enters into force first in 2016, unless member states didn't choose to implement it earlier, and the SRF will reach its target level of funds in 2024. Banking Union is built upon single rule book. It's the orange block on our graph. And the most important part of the single rule book for prudential supervision is, of course, Capital Requirements Directive 4 and Capital Requirements Regulation, CRR, and together they constitute a package implementing Basel III in the EU. The whole comprehensive assessment is concentrated on capital requirements and capital ratios. ECB, as a single supervisor, will be checking if the capital requirements are met. If not, it might take various supervisory actions. ECB might also initiate the resolution process of a bank if the breach of prudential requirements or any other factors indicate that the bank is failing or likely to fail. If I was to draw a parallel, the capital requirements are supposed to be fire protection system because, as you see on our graph, they are improving banks' loss-absorbing capacity. Supervision is, in a way, a smoke detector, whereas resolution will be fire extinguisher. The banking structure, the block on our slide in deep orange at the bottom, is still missing. It is a currently ongoing legislative proposal, the last of those proposed by Michel Barnier, and in our opinion, in Finance Watch opinion, it is the key element and should be the foundation of the whole regulatory reform. Without it, the new tools risk being not credible and they might not work during the next crisis. Drawing the parallel. Without the banking structure reform, the firefighters will be caught empty-handed in the next crisis when a big bank is on fire, and we fear that without the banking structure, the fire protection is not effective, so there will be a fire. Coming back to the stress test and comprehensive assessment. I believe it is worth to spend some time clarifying how the stress tests are designed and executed at the EU level, because I believe that in many questions we recently received, there were signs of some confusion. So, some history. The EU-wide stress tests for banks were conducted for the first time in 2009 by the Committee of European Banking Supervisors, CEPS. It was the predecessor of European Banking Authority, EBA. And the last EU-wide stress tests were conducted by EBA in 2011. What is different in this year's exercise? The stress tests have been designed also in coordination with the ECB, which is preparing itself to become a single supervisor and is conducting a comprehensive assessment. ECB becomes a single supervisor, and it needs to have a full information of underlying banking system. Comprehensive assessment comprises of a risk assessment, asset quality review, and stress tests. We will discuss these building blocks in a moment. EBA is coordinating the stress test, both stress tests being a part of comprehensive assessment and those for member states outside the Eurozone. The same scenarios are used. The difference is, of course, in sample of banks. And this difference comes naturally from geographical breakdown, Eurozone countries only versus the whole Eurozone, whole European Union, sorry, but also because of the levels of consolidation and the predefined criteria. EBA sample of banks covers at least 50% of each member state's banking sector, and we have to remember that in case of the EBA sample, stress tests are conducted on the highest level of consolidation as described in Capital Requirements Regulation. So the perspective of single market is taken into account. To put it simple, subsidiaries are not stress tested separately. The consolidated situation of a banking group is. And EBA sample banks is 123. The ECB sample of banks differs from EBA sample for Eurozone. The ECB decided to include in comprehensive assessment banks with a balance sheet total exceeding 27 billion euro, and notwithstanding this criteria, 3 most significant banks in each of the Eurozone member states. The sample was chosen to cover the banks which will be subject to SSM, taking into account some possible balance sheet developments from 2013 onwards. As I already mentioned before, the difference between EBA sample and ECB sample results also from the level on which the stress tests are conducted. The EBA subsample for Eurozone banks will be smaller because it is performed at the highest level of consolidation, whereas ECB will be testing subsidiaries if they fulfill the criteria you have on the slide. So, when the parent is outside Eurozone and the subsidiary in the Eurozone fulfills the ECB criteria, the EBA sample will cover consolidated situation of the group, and ECB will include the EU zone subsidiary or subsidiaries, subject how many of them fulfill the criteria. But if the parent and subsidiary are in the Eurozone, the subsidiary is not tested by ECB separately. And maybe to make it simpler, for example, HSBC France is in ECB sample, but not in the EBA sample, where the HSBC Holdings PLC is being tested. The same is for the HSBC, for example, subsidiary in Lithuania, which is in the ECB sample. For example, Swedbank AB is in EBA sample on the highest consolidation level, and its subsidiary in Lithuania is also in the ECB sample. But it doesn't mean that the banks are tested twice. If the samples overlap, the stress tests fall into comprehensive assessment.
Sorry to interrupt here, but there might be some confusion about the figures. So there are 120 banks supervised in the SSM, and so why the SCB is testing 130?
Okay. As I said, the comprehensive assessment was conducted for 130 banks. The comprehensive assessment sample was bigger to have some buffer. The banks might have changed, balance sheet might have changed, so the significance criteria might be met by more banks. And we cannot forget that apart from direct supervision of significant Eurozone banks, EBC will be responsible for indirect supervision of all insignificant banks. So there is no contradiction here. Okay, so comprehensive assessment is a very significant technical exercise involving banks, their balance sheets, recording, reporting, verification, and in numbers, and I like numbers, it looks as follows. 130 banks, 12 months, 26 national supervisors involved, 85% is the coverage of Eurozone area banking assets, which is quite extensive, and 6,000 people involved. It is estimated that 6,000 people from ECB, national competent authorities, as well as from the third-party audit firms were involved in this exercise. If we look at the main building blocks of the comprehensive assessment, it is asset quality review and stress tests. There is a third pillar, risk assessment, which was the starting point of the whole exercise, and everybody forgets about it because it is not that catchy. ECB simply looked at all the potential elements of risk in the configuration of the balance sheet of banks. Asset quality review is a backward-looking test of asset valuation as of 31st of December 2013, so point in time. It is aimed to enhance the transparency of bank exposures by reviewing the quality of banks' assets, their valuation, which of course depends on their quality, as well as valuation of any collateral held. In other words, AQR is to deal with legacy assets, and it is to reveal zombie credits, so credits extended to firms which are not doing very well, but banks do not want to recognize it in their own balance sheet and profit and loss, and are rolling those loans over. Yeah.
Okay, so could you tell us what are the advantages of the AQR, so the asset quality review?
If it is effective and successful, it should result in a balance sheet showing true and fair view of reviewed assets, which should then boost confidence in the markets and to the banking system as a whole. And when all the losses are revealed and finally accounted for, and banks are recapitalized, it should lead to increased lending.
Okay.
And such a balance sheet after the quality review should be the starting point in a forward-looking stress testing. Stress tests generally can be described as a supervisory tool designed to assess the resilience of a financial institution to some adverse market developments. Stress testing in this round of stress tests means applying two scenarios to bank balance sheet. Baseline scenario is the scenario which should cover most probable development in the following 3 years. Adverse scenario describes some shocks to the economy. Application of two scenarios results in a sequence of possible balance sheets of the bank for the years 2013 to 2016, and it shows bank's financial position if the regulatory ratios are met. I will now move to the details of AQR. AQR is a risk-based exercise, meaning that the ECB concentrates on those parts of the balance sheet where, based on given existing information, it believes most of the risks are located. In other words, since it is unrealistic to test every single bank exposure, the most risky classes are taken and sampled. It is in a way a second audit of some positions of financial statement, and the procedures, as you see in the manuals, are indeed based on international auditing standards. Supervisors and auditors hired to assist them from the third-party auditor firms are concentrating on two asset classes where the risk is more likely to lie. Those asset classes are loan portfolios and the level 3 fair value assets. Loans, no doubt, are of course the most important component of a balance sheet of a traditional bank. And level 3 fair value assets, these are mainly financial assets, like securities or derivatives, which should be accounted for in fair value. But the problem is that there is no observable market price derived from an active market for them. So the fair value cannot be taken from the market. There are no transactions. And there are also no transactions for similar assets. So they have to be priced by a pricing model with some unobservable inputs, calibrated or historical data. And since these are the pricing models and there are no observable market prices, the risk of accounting misstatement is relatively high in this asset class. That's why they are covered by asset quality review. But coming back to the procedure. Phase 1 for the loans was creating so-called loan tapes, so choosing the sample of loans. The sample should cover 50% of banks' credit risk-weighted assets, and as far as the level 3 fair value exposures are taken into account, the most complex ones. But you have to remember that level 3 fair value assets are checked in case of banks with material level 3 exposures. That means that not all banks will be analyzed. I think that there are around 30 banks in the sample with material trading portfolios, and Yeah, by the way, it shows concentration of the traders on the European market. So, when the sample is chosen, we have phase 2, which means that supervisory teams will be looking specifically at individual asset items, individual exposures, and they will be checking the underlying documentation and existing information. They will be asking questions like, what does the information reveal? Is the item allocated correctly? Is there any impairments, so the overstatement of the loans, to be recognized? What is the value of collateral? Should the exposure be reallocated to a different risk bucket? For banks with material level 3 non-derivative exposure, the revaluation of the most important securities will be carried out, and for the banks with the most important trading books, a qualitative review of trading book core processes, which means, for example, independent price verification or product approval, etc., will be also carried out. And it will be, of course, combined with a quantitative review of the most important derivative pricing models. And ECB expects that fewer than 10 derivative pricing models will be reviewed for each bank included in the trading book review, depending on the size of the bank's exposure to over 3 derivatives.
And what are exactly the findings of the AQR? Can you tell us a bit more about it?
The adjustment of the asset value, and I can show it, I think, will have direct impact on equity and hence on regulatory capital, common equity tier 1, after AQR. But there might be other issues identified, for example, wrong assessment to risk categories, etc., which might have an impact of calculation of risk-weighted assets and then regulatory ratios. And at the end of this process, there is phase 3, which is the check of consistency and cross-checks between the countries. Okay, so to give you some flesh to the bones, we present you to an AQR template. In this template, the adjustments to asset values recognized in AQR are translated into capital ratios. Because if the capital ratios are met after accounting for additional provisions, bank, although recording some losses as a result of AQR, do not have any capital shortfall. So, before AQR, the bank reported capital ratio and risk-weighted assets as of 31st of December 2013, and now we have the findings of AQR, which are here for the loans and here for the level 3 fair value assets. They have to be translated into capital ratios. But first, what bank presented at the end of December 2013 must be translated taking into account phasing in arrangements of CRD4 CRR, because there are various phasing in arrangements in this package, especially when it comes to deductions to the common equity tier 1. And in terms of comprehensive assessment, the ECB decided to apply the phasing in provisions. So in other words, there is no full loading of CRR from 2014. Those phasing in arrangements have impact on capital and risk-weighted assets. And this is the cause of different ratios which you see here and different risk-weighted assets, because otherwise there is a static balance sheet assumption. So the balance sheet as it was in 2013 is taken to AQR and also to stress test. I will come back to it later. And there are no changes in the composition. So the only changes that you see here, like the drop in capital ratio and the drop in risk-weighted assets, is due to phasing in arrangements of CRD4. Then, as I said, we have the adjustments, absolute values of adjustments here to the loans and here to the available capital because of the fair value adjustments. And they are also phased in because the provisions have impact on deferred tax assets have impact on own funds, there is offsetting tax impact, so they also have to be presented in those 3 years. And at the end we have AQR adjusted common equity tier 1, which is here, and as you see from 11%, those adjustments are reducing it to 10.3%, so there's a reduction of 0.7%. And at the end of 2016, we are landing with an AQR adjusted Common Equity Tier 1 of 8.2%, which is still meeting the threshold, but it's very close. Okay. So finally, stress test. And I will need to make two remarks with regard to their design and implementation. One remark will refer to sequence of performing stress test and AQR, and the second to the static balance sheet assumption. As I mentioned before, asset quality review should result in a true and fair value of the most important positions of bank's financial statement. And this verified balance sheet should be a starting point for stress tests when the scenarios are applied in a horizon ending in 2016. The problem is that because of the timeline and time constraints and deadlines, the AQR was conducted simultaneously with stress tests. What does it mean? It means that banks were stressing the unadjusted balance sheet, so before AQR, and the ECB decided to join up the results at the latter stage. And the methodology for joining up the results was published first in August 2014. The joining up of AQR with the stress test results might be quite complicated exercise. There are 40 pages in manual about that, because stress tests are done in a bottom-up approach. So banks are submitting the outcomes to the supervisor. They are running the stress tests on their balance sheet. And ECB cannot reveal all the findings from the AQR to banks, since listed banks would have to reveal it to the investors as well. Moreover, it is not only to integrate the quantitative data, but also qualitative, so-called new information.
Yeah, maybe we have to be a bit more concrete here. Can you give an example of qualitative finding?
So I will give you one example. If bank was not classifying some loans as non-performing, so-called NPLs, and then AQR showed that they are non-performing, it is a new information. And this information suggests that the default rates that bank has observed historically for the internal models were inappropriate, and those default rates were used as an input to calculate risk factors in those internal models, such as probability of default. So the stressed risk-weighted assets might be miscalculated. So as you see, it's quite complicated when we think about the joining up. But coming back to the stress test. The starting point is the end of 2013. The two scenarios are applied. First one, so-called baseline scenario. It is a set of macroeconomic factors which are likely to happen. And this scenario was prepared by the European Commission. The common equity tier ratio to be met is 8%. And we have also adverse scenario, the real stress, which provides for some shocks. And it should result in a capital ratio not lower than 5.5%. But there is another weakness of stress testing which I need to mention, and this is the static balance sheet assumption. We touched upon it a bit earlier, but I want to elaborate more. This assumption has the virtue that the actual balance sheets as of December 2013, and not some uncertain plans, were submitted to the stress test. But then their composition remains unchanged. It means that if an asset matures within stress test horizon, it is assumed that it is replaced with an exact position. And if any of the macroeconomic shocks is in the economy, the bank doesn't change the balance sheet composition. So the static balance sheet assumption is obviously unrealistic, because even if the given stress scenario becomes reality, banks will react to the scenario. We've seen liquidity hoarding in the last crisis, we've seen asset fire sales, we've seen changes in the strategy. So the static balance sheet assumption disregards the second round effects and some systemic risk implication. It is a compromise, of course, driven by the need of simplicity, but we all have to remember about this compromise. It also must be pointed out that the stress tests rely heavily on banks' internal models. Why? The scenarios, the macroeconomic scenarios, have their narrative and concrete economic factors like drop in GDP or increase in the unemployment rate, which you see in this block. But they have to be translated into balance sheet impact via portfolio valuation translating into profit and loss and changes in risk-weighted assets. For some categories of macroeconomic indicators, the process should be easy and transparent. For example, if we think about a drop in equity prices, it can be easily translated into asset value, etc. But if we think about GDP ratio or changes in unemployment, it is not that simple anymore. And banks have to translate these scenario factors, this macroeconomic scenario on your left, into risk parameters to come to the balance sheet impact. And in case of credit risk, it will be point-in-time probability of default and point-in-time loss given default. And banks, which use internal models for calculations of capital requirements, will use them for this translation as well. For other banks, EBA prepared benchmarks to translate the scenario into risk parameters. These guidelines, however, are not published. In our opinion, the reliance on capital requirements and internal models hampers the transparency and comparability of comprehensive assessment. The last crisis revealed how unreliable internal models are. For some banks, the capital ratio was still met, thanks to low risk-weighted assets when the bank was failing. But so to say, it is not the problem of the stress test, but inherent issue of CRD4, CRR and Basel III framework. ECB, in the course of comprehensive assessment, was not able to verify internal models in the course right now. This verification will be done later in terms of ongoing supervision because it's like an assessment within so-called Pillar 2 supervisory review. So, as a result of comprehensive assessment, we will receive 3 capital ratios: AQR adjusted ratio, ratio under the baseline scenario, and ratio under adverse scenario. In the example above, which you see, this is taken from ECB disclosure template. By the way, those disclosures we have to acknowledge the fact that there will be such an extensive disclosure. Bank has a common equity tier 1 ratio at the end of 2013 of 10%, and aggregated adjustment due to the AQR decreased it to 9%. I'll try to. Here we have 1% drop because of AQR. And this adjusted balance sheet should be then taken and stressed, but please bear in mind what I said before. So in our example, the common equity tier 1 after baseline scenario is 7% here, which is not satisfactory since the bank should have a ratio of 8%. And the same AQR adjusted set1 ratio and balance sheet is taken to the stress scenario. And after the stress scenario, we are landing at common equity tier 1 ratio of 5%, which is also not satisfactory. There is a shortfall of 0.5% to be covered by bank. So, on Sunday, ECB publishes results of the comprehensive assessment. Banks have 2 weeks to submit plans for restoring their financial position, and they have 6 months to cover capital shortfalls revealed in AQR and baseline scenario, mostly by common equity tier 1 instruments, and 9 months to cover capital shortfalls revealed in adverse scenario. So we are moving to the most exciting part. What if there are capital shortfalls? Capital shortfalls mean that the target ratio of 8% or 5.5% is not met, as you've seen on the previous slide, and to improve the capital ratio, banks can either work on the nominator, which is capital, or on denominator, risk-weighted assets. Naturally, ECB expects banks to work on nominator by issuing equity or additional tier 1 instruments in limited cases, however, or retaining earnings if there is any profit at the end of 2014. But to improve the ratio, banks could of course decrease the nominator by asset sales and recalibrations of internal models to arrive at lower risk-weighted assets. But these measures are for the supervisor eligible as restoring the capital position only under strict conditions, and it is obvious. Imagine a bunch biggest banks flooding market with assets at the same time. ECB points out that deleveraging in form of asset sales will be applicable only when the asset sales are distinct from normal business operations, as an example, ECB gives the sales of securitization portfolios. So, banks have to attract new capital in the market or retain earnings. It might be difficult not only for those who are not listed, and if they fail to do so, there is no common public backstop, so the member states might want to inject public money, of course provided that they have enough in their pockets. So there are basically two sets of rules protecting taxpayer: state aid framework for banks and resolution framework, BRRD SRM. What do I mean by protecting taxpayer? By protecting taxpayer, I understand contribution of shareholders and creditors to the recapitalization prior to any use of public funds. In point 3, I am also mentioning ESM direct recap instrument for systemic banks, because if it is used, it triggers creditors' participation already in 2015, which is 8% of, which means bailing in 8% of total liabilities, including own funds. So, in 2014, the rules protecting taxpayers are the state aid rules with the burden sharing principles. Burden sharing means that injection of public funds means that the shareholders and hybrid capital holders and junior creditors, which are subordinated debt holders, must take losses first. There is also no cap on the amounts to be written down or converted. In resolution framework, which enters into force in 2015, a need of injection of public funds generally means I'm running late.
Yeah. I just saw that we are already at 33 minutes, so I don't know if you continue a bit, maybe the last 2 slides, how much is left? So we can ask, because there are already some questions coming in.
Okay, so maybe we'll say on the precautionary capitalization, you can refer to our last policy brief.
Exactly.
And I will leave it here. Unfortunately, for the most exciting part, we have no more time. That's my fault. I was talking too much. Sorry. And yes, if we think about the precautionary capitalization, which is basically recapitalization for the losses that are not incurred or incurred in the future, which is debatable what is it, and it might mean only the adverse scenario, but it will be subject to some of interpretation, which hampers the credibility a bit of resolution. If the banks do not they do not recapitalize in 2014, we are on this highway, hopefully not highway to hell. And if the markets do not want to build the higher buffers for the banks, and the financial stability is threatened, and all the conditions for a safeguard clause and escape clause in the both frameworks, which are to protect taxpayers, are met, we are ending with a bailout. But it also means that the injection of own funds is shifts the injection beside the resolution framework, so no tools from resolution like change of management board or change the strategy might be used. And as our favorite Mr. Haldane says, when a big bank fails, bail-in is never a soft option, and the temptation is always to for the governments to reach for the checkbook. So, okay, more, as I said, in our policy brief, and I will be happy to answer the questions.
Yes, thank you very much, Paulina. I'm very sorry to interrupt you like this, but as you said already, I think the really detailed paper policy brief from Paulina on this topic that you can find on our website. And we hope that you read it in detail, that you also find the last graphic, so you can go into this. I already got a few questions, so please feel free to send yours if you have. There's one question. Comes from Gerard. Do we have early leakages or rumors about the test results? Can you say something about this?
Everything from today to Sunday is like pure speculation. So no, we as Finance Watch have no leaks.
Yeah, it's only like what you see in the press, but yeah, in fact, everybody has to wait until Sunday, I think. This is one question from Philippe, which is more on the internal models from the bank. So he's asking, how far do you think the ECB has had the capacity to challenge banks' internal models in the AQR stress tests?
It's a good question, very good. But unfortunately, the comprehensive assessment was designed in a way that those internal models were taken as they were. So I don't believe that there were any challenges because of the deadlines, because of the work done, and I think that when looking at the ECB stress test or comprehensive assessment results, we have to look more at the AQR, which brings more added value, because as I said, the over-reliance on internal models is something that hampers the transparency and comparability of this exercise, like the concentration on capital requirements in general. That's why the previous EBA tests failed.
There's one other question which is concerning, so what would you say, what is the main strengths of the comprehensive assessment, if you have to sum it up?
For me, I would say, as I just said 2 minutes ago, AQR, it's an extensive check of loans and fair value 3 exposures, and if we deal with the zombie assets and zombie lending and fair value mispricing and have a true and fair view, I think it's the main value added, and we have to acknowledge this fact. Also that 130 banks were checked. It's good. And as far as the stress scenario, you can ask yourself if one stress scenario is enough. In the United States there are various stress scenarios. We have one which is more severe than the previous ones. If it's enough, we don't know. Maybe adding another one would be better, but I think that the static balance sheet assumption hampers in a way the results. So once again, I think that the AQR is the biggest, I would say, acknowledgement.
We have some other questions coming in. There's so many, so let's take this one. Why is the reliance on the capital requirement and the internal models problematic in fact?
If we concentrate on capital ratios, we are in the situation that we had before, because risk-weighted assets do not move when the risk moves, and sovereign debt was like an extreme example of this. And we had banks who met the capital ratios perfectly but were failing, and for example the supervisors didn't realize that the total capital ratio is met but the leverage decreased by 2, which shows how the risk is increasing and the underlying assets, how risky they are, so, and how risky the banks is. So that's one thing. And of course, if the risk-weighted assets are calculated by internal models, and every bank has another internal model, the comparability of the whole exercise is hampered.
Okay, then we have one which is in fact more on the policy brief that you have written, which is maybe you can you can say it once again. Why is it still necessary to have precautionary recapitalizations? If you
or basically the idea of the precautionary capitalization is to it is for the losses from, so to say, adverse scenario, if we agree on this interpretation. So to protect the financial stability. If the bank is otherwise solvent, but it needs to build up capital base for this future adverse environment or adverse economic factors, it shouldn't, and it cannot do on the market. It shouldn't bring the second round effects like because this bank is not failing. So, in a way, this safety valve, that if you want to protect financial stability and it comes to the adverse scenario, that the injection might be done. But on the other hand, when we use the escape clause and we shift the precautionary capitalization outside the resolution framework, it means that none of the instruments which are in the resolution framework, like, as I said, change of management board, change of strategy, they might not be used. And we have something like very strange, because we will still have burden sharing from the state aid, which is good, and the European Commission will decide. The European Commission controlling the measures has the last say of the application of burden sharing and resolution. But, however, we are switching off all the other instruments from the resolution framework.
Okay, thank you very much. There was, I think, one little clarification on how it was Ivo asking how many non-Eurozone banks are assessed.
Sorry, I don't remember, but you have on the EBA website there is the whole list, so you can refer to it. I don't remember the division.
Okay. And maybe this is a bit about the percentages, like the Gerard was asking. AQR is only on an example, and what is the size of it compared to, like, in percentages?
The sample for the loans, as far as I remember, should cover 50%, but credit risk-weighted assets, so not the absolute amount. But the sampling is something normal, because it's like the second audit, so you have to have a level of confidence, and you have like statistic model which shows how many exposures or how much exposure you have to check to have the confidence that you found all the mistakes, and then you can extrapolate those mispricing or overstatement to the whole portfolio. So the sampling is something normal in audit. Yeah, it's not possible to check every single exposure in every bank.
I think we have one from David, which is, how are the capital requirements of the stress test linked to Basel III, since the capital rules there will be fully implemented in 2018 and not 2016?
Yeah, so it's also a very good question. The ECB decided that for the comprehensive assessment at the end of every year, so 2014, 2015, 2016, it takes into account the phasing in arrangements. It means that there is no full loading of Basel III. The phasing in arrangements are taken into account, so but at the end of 2016 we will have the stand as it is foreseen in the CRD4 CRR directive at the end of 2016 for the deduction from Common Equity Tier 1, from some transitional provisions, from deductions, for example, for unrealized losses, and so on and so on. But the capital ratio, which is 8%, on the other hand, is like full loading of the Basel requirement for the Common Equity Tier 1. I hope I answered your question.
We have one question from Caroline. So she's just asking, so the results will be displayed bank by bank, so naming each bank, correct?
Yes. On the ECB website there is a disclosure template which is quite extensive, and for every bank it will be filled. You will find shortfall resulting from AQR, shortfall resulting from the baseline scenario, shortfall from adverse scenario. You will see the total amounts of the verified assets and plenty of useful information. Also leverage. Although leverage is not binding, it will be showed in the template, and it will be for sure an interesting information.
I think we have to finish now. I'm sorry we did not have the chance to answer all of the questions, but I think this was a very interesting webinar, and I hope you enjoyed it as well. I think now we have to wait until what Sunday brings, and so all the more we wish you a very good weekend.
Yeah, thank you very much.